This is Michael Fox, and this is the Prospector News Podcast. And joining me again, we have longtime contributor and friend Chris Temple of the National Investor. Welcome, Chris.
Well, hello again. Here we are at another Friday and more fun and games.
Yeah, we've been talking to each other quite a bit in the last several weeks, and interesting times and lots to talk about. So this week we've had the FOMC meeting, and we're up another quarter point in spite of the banking crisis and what the markets probably thought they should be doing. But you called it last week, and I thought at the time you were pretty right on with your call that they would continue to press this.
Well, I thought they would. I think that when you look at how the market is pricing things in at the end of the week here, we're back to a place where just a few weeks after the markets had, capitulated themselves and before all the banking failures started happening, they said, okay, I guess the Fed is right. And so we're not going to price in rate cuts this year. We're not going to price in a pivot in 2023. We're not going to price in any rate cuts, period, until next year. Now, all of a sudden, this morning, if you look at the Fed funds futures markets, they're farther away now from the Fed than they've ever been during this whole process. They not only think the Fed is not going to follow through with one more rate hike, like they promised to do on Wednesday, or I should say forecasted to do on Wednesday, but that they're going to have to cut a full basis point between now and next January. Now, they may or may not do that. They may do more, they may do less. Who knows? This is an evolving process, and none of us have all of the answers yet. We can make some inferences. But yeah, the Fed still has got to stay tough, if for no other reason than to save face and not show panic itself. So that was the key reason why the Fed raised interest rates a quarter of a point. Some of the core inflation measures, the service inflation numbers and so forth, as you and I talked last week, are still too high for the Fed's taste. They want to bring that down. But the Fed also had a job on Wednesday to acknowledge that, these banking failures and the throwing a cold bucket of water on risk appetites and so forth is doing some of the Fed's job for it, and is unquestionably going to lead by itself to a contraction in credit creation, which is a big thing, and then therefore a contraction in economic activity going forward, all else being equal. The only thing we don't know yet is the magnitude of that. And the Fed has made very clear that it intends to keep depositors liquid, notwithstanding Janet Yellen's, saying that one minute and something different the next minute. But they're going to make sure depositors don't take it in the rear end. But they are willing to see a lot of people in the markets get hit, because that is going to seriously damper a lot of the securitization that goes on, a lot of the Wall Street enabling of credit. And again, they've got their fingers crossed that this is going to do a big part of the Fed's job in bringing inflation down. But again, as we've said all along, and now it's just that much more evident, and the Fed, didn't want to come out and admit this in so many words, but we are heading into a recession of some manner. And that is one of the things that's going to be required if they hope to get inflation down. I don't think they're going to be successful in doing that, at least across the board. Some areas they will, some areas they won't, but we'll see. So wrapping that thought up real quick, Mike, Powell's job was to sell everybody on the idea that fighting inflation by still raising rates as he did, maybe doing it one more time, is one subject and totally different, he wants us to believe anyway, from the other, and that is where the Fed has to bail things out, it will still do so. A lot of people, of course, are joking about it. I mean, the Fed added yet almost another 100 billion in the last week to its balance sheet. So that's something like 400 billion or close to it in just the last 2 weeks. But that's not quantitative easing again. That's an accounting or clerical thing.
Yeah, I like how they try and smooth that over, just like two negative quarters, there's no longer a recession. It's wondrous how we can change the definitions of things as we go along. But
Yeah, or you see the whole country of France burning down, and that's freedom and democracy. Yeah,
well, yes, of course. But the thing I look at with this, Chris, is that over the past week, as we've unwound what happened at the Silicon Valley Bank, I've heard pundits talk about how it was malinvestment by the bank. And I'm going, well, they were invested in treasuries. That's supposed to be the most secure thing you can invest in. So that doesn't seem like malinvestment in. And then they started to run off on the, they didn't hedge their investment. And I look and go, okay, that's a good argument. But if you look at Credit Suisse, who basically had the same problem unravel on them, the hedge derivatives on them jumped from like 100 to like well over 1,000 points. And how do you hedge when it's costing you 10 times the value to hedge against the thing collapsing? And I still think that the continued raising of interest rates by the Fed is going to continue to put pressure on the banking sector.
Well, it will. The Fed knows it. Everybody else knows it. I don't like to get too much into the weeds and conspiracy theories and so forth, but I do believe that there is an agenda here where, when all this is said and done, just to use one example, or one factor of this, I guess I should say, or one outcome, the U.S. banking system some years from now will look like the banking system in Canada, where you have a handful of big national banks, period. You don't have local building and loan savings and loans credit unions for the most part, or any of that kind of thing. So that's going to be one of the outcomes of this in the end. The Fed knows it, and I think the Fed wants some of this kind of thing. They want this kind of stress in the system because it helps to consolidate the banking system, one of its goals. You got less people that aren't singing from the same song sheet. And it also, I think, continues to serve as a diversion against the Fed itself. And regrettably, and we've talked about this many times, that's a subject that virtually never comes up. We'll have congressmen and senators and pundits talk about how the Fed needs to be more diverse, and the board governors, the different people in regulatory positions. If only we had more women and people of color and transgendered and whatnot, then everything would be wonderful and the system would still be working better for the people. That's patently and demonstrably false until you change the system and its priorities itself. It doesn't matter who's running it. So, but then, pardon me for digressing a little bit, but that always irks me that the biggest perpetrator of this whole thing systemically is the one that we can never question. We can quibble over Powell and the pace of rate hikes, whether he should be doing it or should be doing it, but nobody asked the question, why are we here in the first place? Why do we have a fractional reserve system? Why do we not have a currency board or public credit system, or social credit system that benefits people and that is controlled by people, and that does not require us to borrow our own money at interest from a private bank that creates this money out of thin air, and then to exact payment makes eternal debt slaves out of all of us. We shouldn't have that, but that's my preaching for the day.
No, but you know what? That's fair. But I hear what you say about it consolidating the banking system, but then you take a look. Credit Suisse was a pretty large bank to be going down. It got bought out by a forced buyout by a smaller bank to keep depositors safe in Switzerland. But at the same time they did that, you took the Saudi Arabian sovereign wealth fund and gave them a pretty good haircut in that they own 10% of Credit Suisse.
Yep. Well, and I'll tell you, one of the things, and I'm going to be writing about this in a very near term. I've already got the outline of part of a newsletter on this whole subject. You've had Saudi Arabia and Iran recently make peace. Now that has been followed by Saudi Arabia and Syria making peace. Between the banking system and how it has this attitude, as evidenced by what you just said, the way that the Saudis were treated over there not that long ago, helping hand to keep Credit Suisse afloat. Now they're getting totally screwed for their troubles. Between that and the abysmal and part treasonous and part just disastrous foreign policy of the U.S., we are in lightning speed galvanizing the rest of the world against the West generally, and the U.S. particularly. And what happened to the Saudis over Credit Suisse is going to accelerate that. You look at Deutsche Bank right now. That's the flagship for Germany/Europe. Doesn't get any worse than that. Look at what happened to their credit default swap prices as this week just ended. Another vertical spike. And what really should have you losing sleep tonight, if you think that Deutsche Bank is going to be saved or anything, is that Jim Cramer on CNBC is telling you that that's a good, safe, and solid one too. Just like he's
good
done
God,
with all the
no.
rest of the banks.
There's the kiss of death to Deutsche Bank right
Pretty
there.
much. So look, the powers that be are playing an interesting game here. In one sense, they're playing with nitroglycerin, but I'll never forget that even if it comes at the expense of some of these big legacy banks having to be thrown into shotgun weddings with another one or being folded or whatever it is, the central banks, the central planners will say and do anything to make sure that they don't lose their grip on power, and to make sure that people of this planet in large numbers don't look behind the curtain and say, wait a minute, you're the ones that are the cause of all this? So they will sacrifice even big banks. They will put on a show and have some heads roll over this, and they will pretend as part of all of this to be the good guys. Say, okay, well, whatever it takes to do, we're going to make sure that depositors are protected and that the hoi polloi don't get hurt too bad. And instead of being the slaves of Silicon Valley Bank or Signature Bank or Credit Suisse, you'll now be our slaves. We'll be the big brother to you. We'll be the credit providers to you directly, not through these banking intermediaries, but you'll have a straight umbilical cord / chain to the central banks.
Well, I tell you, in all honesty, Deutsche Bank scares the hell out of me. It is beyond too big to fail.
Yeah.
The alarm bells started going off on Deutsche Bank about 6-7 years ago. And at that time, I kind of looked and was wondering, okay, if this goes down, what's it going to do to the proverbial house of cards? And you realize that their balance sheet was greater than Germany's entire gross domestic product at that time. And so you're looking, okay, well, the Germans can't bail it out. So it's going to have to be the European Union. It's going to have to step in here to bail out Deutsche Bank because it's too big for Germany to bail out. Is the EU going to be prepared to bail out Germany's bank when they weren't prepared to bail out Credit Suisse and some of the Italian banks that were teetering on the brink there? Or is this going to become a worldwide problem and all the central banks are going to have to get together to bail this out? Because I'll tell you right now, if I were to send you money through the SWIFT program, chances are Deutsche Bank's going to touch that transfer as it goes between my credit union in Canada to your bank down in Florida. It doesn't seem to matter where I send money to, some of my contributors that are overseas or in the United States. Deutsche Bank's got their fingers in that, in that transaction.
Well, the whole global financial system is incestuously intertwined. And so to a very great extent, it's that old saying of a chain is only as strong as its weakest link, and there's a lot of weak links. Generally speaking, the story of the last several years, Mike, has been that in relative terms, and underscore relative terms, the US banking system was considerably stronger than Europe. It's been widely recognized that in the wake of the financial crisis in 2008, that all of the different steps that were taken, whether anybody, including me, liked them or not, it did somewhat shore up the US banking system. With the US banking system, and again, generally speaking and in relative terms, so don't send me nasty grams that I'm saying the banks are strong. I'm not saying that. But in relative terms, they're far better off than Germany, even, let alone all of Europe, because Europe's banks never did recover from 2008. They have been papered over this whole time, and you've not seen a rebound to speak of in their financial health, as you did to some extent in the US banks. Now, that said, you were talking about the size of the nut that somebody would have to worry about were Deutsche Bank to completely implode. Here's a number that people should hang their hats on: $2 quadrillion. That's $1,000 trillion. That today is the notional value that people know about and can at least half quantify of all the derivative transactions and the notional value of all derivatives in the world. So we wring our hands over a $32 trillion whatever debt here in the US. That's the on the books part of it, the more overt part of it. We look at a global economy that has a GDP, to just use a simple round number, of about $100 trillion right now. Okay. And yet the total notional value of derivatives, which once upon a time, securities values and bonds and stock markets and so forth in a simpler age, reflected, at least somewhat, the overall economy. Yet these financial instruments are 20 plus times the value of total global GDP. How the hell did we get here? And what happens, back to your original point, Mike, if these things start unraveling? You don't have enough existing credit. You don't have enough existing credit facilities, anything, if all of this stuff starts to implode. So this is the dangerous game that the Fed and the other, well, the Fed chiefly, but the other central banks to some extent are playing. Now, at least, and to be overly simplistic about it, maybe, at least Japan and China have got the honesty to tell us, hey, we can't afford to be tightening. They've both been going the other way on monetary policy for a while. And the interesting thing is going to be, at what point do the Fed, the Bank of England, the Bank of Canada, the ECB, when do they get lurched back in the other direction? The Swiss National Bank just had to capitulate big time over just Credit Suisse. But and most people seem to think that that's coming with the other Western central banks. But as the market activity at the end of this week reveals, people have no idea what that really is going to mean in the end. I mean, there's this idea that there's going to be this binary outcome. And if all of a sudden now with the bond market rallying, interest rates plunging again because everybody's thinking the Fed's going to have to pivot and start lowering rates and everybody's going to be hunky-dory after that. No, when the Fed finally does that, it's going to tell you things are really turning to shit, and it's going to get worse, not better.
Yeah, you jumped ahead of me. I was going to point out 7 years ago when I was looking at it, the derivative market and holdings of Deutsche Bank were about $1.4 trillion.
Yeah.
So, you've answered the question I was going to ask. If Deutsche Bank fails, what happens to the derivative markets, and what does that do to the rest of the banking industry? Because those, it essentially could make derivatives completely worthless.
Well, a lot of them will become completely worthless. And look, in one sense, I don't want to, overstate this in an apocalyptic kind of way. A lot of these derivative contracts are just paper chits, at a high uber leveraged level between financial institutions. They can implode or evaporate, and there may be no repercussions of that. But the problem is when you get down deep enough in some of these things, if you were to have a cascading effect, now you start to impact the value of actual loan portfolios, not derivations thereof to the third power, so to speak. And that is the thing. And I think of all the things that people need to take away from this week and from the Fed meeting and so forth, is that a major period of credit contraction and deleveraging is now underway. The Fed can start cutting interest rates tomorrow. It's not going to change it. They can continue to raise interest rates, and it certainly is not going to change it. But you've got a deleveraging underway right now, which, when you get right down to it, is the inevitable and necessary reaction against the broad money supply in 2 years increasing by a third. That has never, ever happened in history. So this has to happen. The Fed knows it. The Fed won't come right out and admit it, but the Fed wants and needs this. The question is, can it retain control? And you've probably seen the cartoon my cartoonist Jerry King has done. I trot it out at times like this, where Jerome Powell very much now is in a position of Henry Frankenstein. And he's created this monster out of all cobbled together parts of dead bodies, in this case, cobbled together securitization schemes and credit creation schemes and everything else, thinking he's going to be able to control the monster. In the end, he might not be able to.
Yeah. I look at this and go, like, it's kind of like 2008 again, but different. But the common thing that I'm seeing here is we're running into a danger where the banks just simply stop trusting each other, and then that's when the credit markets freeze up.
Well, and that's your final few words are the operative ones, Mike, where the credit markets freeze up, because that's the doomsday scenario for the Fed. The Fed will tolerate what I frankly think is the base case, or my base case as we speak today, of this whole thing. I do believe that one of the similarities to 2008 is that we need to have this substantial period of deleveraging to undo some of the dopiness that the Fed itself created the last couple or 3 years. What I think is going to be considerably different, among many things, is that rather than taking place in a matter of days or weeks, this is a deleveraging process that's going to play itself out perhaps over several years, where the Fed just does its best to do, and I think I used this analogy with you before, to do what China has done with Evergrande's bankruptcy, something that they themselves have called a marketized default. Parts of it that were salvageable, they lopped off and sold it to the highest bidder. Some of it people had to take haircuts on. Some of it people, got back almost laughable deeds for fractions of properties that are liquid. And they said, okay, here, you're paid off. When the markets are better, you can figure out how to get your cash back out of this. This is the broad process I think that's going to happen throughout the world, including in the US. And the ever-present and now heightened risk is that the Fed can't keep control of it. And like what happened to Dr. Frankenstein at the end of that first 1931 Frankenstein movie, is that his monster throws him off the burning windmill. The Fed's going to do everything it can to avoid that, and to keep the monster happy or sedated or something. But again, this is going to be a process where we're going to have it unwinding for quite a long time to come, I believe.
And this is basically what you're talking about by your stagflation light thesis.
Very much, because on that subject, another one of the several major differences between the present time when we're going to have a deleveraging and credit contraction and back in 2008 is that it is not going to be easy, if even possible, for the Fed to put inflation back into the toothpaste tube, so to speak. There are a number of things that have changed societally, demographically, the chronic ongoing shortages of just about everything, to the point where, and I discussed this last week with our mutual friend Mickey Fulp, who I'll be with later today. You look at the oil price recently, and it's had a pretty severe drop. I mean, it's dropped by a third since late last year. And that has far less to do with economic fundamentals and supply and demand, which are actually decent to net strong right now, and everything to do with the leveraging of investment portfolios. Don't forget that you can go back to late 2007, early 2008 time period, and I think it was within about an 8-month window, you had the crude oil price at a high of over $140 a barrel, still to this day, nominal all-time high, and 8 months later, $35 a barrel. And neither of those extremes represented the supply and demand fundamentals for gold. What they did represent was the fact that a lot of the activity in markets like that especially are the part of speculators, currency traders, commodity speculators, and whatnot. And everybody in one fell swoop first lurched to one side of the boat and then all the way to the opposite side of the boat. And that is something that could still be a near-term danger for a lot of these commodities. But in the end, you've got globally the story being the same to varying extents for just about all of them. Too little investment for too long, and now not enough to go around of any of these things. So, I suppose if you believe that the central banks have really overdone it, we're all going to go back to the Stone Age for the next 10 years. Everybody go bankrupt, nobody be able to pay their bills, nobody be able to do anything but subsist, then okay, be bearish on commodities. But otherwise, the short-term pain is going to be fleeting because these things are still going to command high prices.
Well, yeah, it's one thing you can probably count on the government to do in a recession is to try and spend on infrastructure. And, if we're going to move to that green economy that, everyone's been dreaming about for the last 10 years, this might be the impetus for governments to start throwing money at that. And then you're going to see the commodity prices jump.
I think it will. And in fact, I've been arguing for a while, and you can make a better case today than ever for this supposition of mine, Mike. But it's inevitable that to try and have something good performing in the economy that is actually a productive outcome from ever more debt that we're going to be bringing on, ever more fiscal measures that will try and, quote, save us from the renewed economic doldrums, that I think that more than ever, the political, financial, all of the needs that we have as a society and what the government's own objectives are, we are going to see the next waves when they come, and they will, of fiscal stimulus and all the rest of that stuff. It will be primarily, if not exclusively, dedicated to those very things you just pointed out. And it's one of several reasons why I think that even though I believe a secular bear market in stocks is going to continue for a while, we're not going to have a 90% drop like we did in the Great Depression. At the worst level last year, we've probably seen the most, or at least the majority, of the eventual drop. I've been saying for months, and I'll say it again, I think in a real world, and given the environment that we're in, the S&P 500 bottoms someplace between 2,800 and 3,200. We're a ways from that right now. But that's not the worst bear market in history. If we get down to that, it might not even be in the top 5 or 6. So I think that at that same time, however, there's still going to be areas of liquidity. There's still going to be things that work. And especially if, our hunch is correct, that, to try and smooth things out afterward, we get more fiscal spending and all this kind of stuff to try and right the ship, it will go into these areas of infrastructure, commodities, the new FAANGs, green energy, mash them all together. And it will be, I think the exclamation point on my view, which we haven't seen this in a very, very long time, but where we will have for an extended period, a secular outperformance of commodities versus financial assets.
Yeah, well, we've started to see that in the gold markets to some degree, and silver as well, and all the other markets, with the exception of oil, has been kind of holding their own.
Well, they have. I mean, the stocks of a lot of these things, though, are still showing relatively little follow through for that for a whole host of reasons. I personally believe that you've got to be extremely careful. Right now, where chasing gold is concerned, I do not think that we're quite yet on the edge of a breakout that's going to take us sustainably to new all-time highs. There's a few other things that have to happen. And also bear in mind that the gold price in the market is not dictated what you think things should or shouldn't do as a gold bug. They're dictated by what the legions of generalist investors believe. Right now, the legions of generalist investors have piled into gold because they think that the Fed is about to start cutting interest rates. That's why the dollar has weakened again. It's firmed up at the end of the week, but largely because of a contrary to how bad Europe might be getting. So that's why the euro has dropped against the dollar as the week ends. But look, if you see one or two more major headaches come in where the global banking situation is concerned, that scares the daylights out of markets again, and it causes a spike in a dollar, gold will do less bad than other commodities. But if you saw a big spike in a dollar, even though it would be stupid fundamentally, don't forget, you've got a lot of funds that went long gold and short dollars recently based on their view that this is it for the Fed. But if all of a sudden you have more problems, if they haven't papered all of this over, you see a big spike in the dollar, and this happened in 2008. Didn't last but a few months, but it happened in 2008. Then people who bought gold recently will have no choice but to sell it. So understand, if you're going to chase this latest move for gold, that's the risk that you're taking, that you believe that things are not going to get worse in the banking system. Sounds silly compared to a lot of the sales pitches out there for gold right now, but that's how it will work in the markets.
Well, it's, as much as I say gold has been up, it's touched the 2000, but there's still pretty significant resistance there. It bounces back down again pretty quick after it hits that point.
Yeah, we're not at the place yet. I don't believe in. Look, you've seen this. I know late last year I put out a special issue strictly on precious metals, and I laid out the scenarios that would get generalist investors interested in the sector again. And I did make some big comparisons to 2008 that you would have to have, without question, two things. One is the realization that the financial danger is over and market danger. Number two, the Fed hitting the accelerator, making new credit available, lowering interest rates, depressing the dollar. And number three, all of that will have little traction in the real economy. It'll just be more money printing with nothing to soak it up. That's what happened in the wake of the financial crisis. It's why for a few years gold did so well. Gold tripled in under 3 years to its then all-time high in September of 2011. And it did it because all three of those things were in place. We don't have one of those things in place quite yet.
I was about to say that it's like me trying to swing in a major league pitcher. I was 0 for 3.
Right. So listen, Mike, 5 years, 10 years from now, no question in my mind, you're going to be very happy if you own gold, if you own some of the better gold stocks, maybe if you own any gold stocks. If we get a secular pick up again in the whole gold sector that goes so ape shit that it drags all of the garbage with it. Okay, but it's look, in my portfolio, as you know, I've got a number of individual equities recommended, but I told folks to get out of both our silver and gold trading positions, leveraged ones at that, when they hit their highs earlier actually the gold we got out of the 1st of February, silver, the big silver leveraged ETF, we sold that late last year. Neither of them has exceeded those levels yet.
No, they haven't. So,
and I don't think they will near term. I'd be happy to be proven wrong because we've got a number of individual companies on my list where if we do get a big breakout, they're going to benefit. But my belief is that we've got at least one more significant likelihood of a spike in the dollar, a free fall on Wall Street that will take everything gold stocks and included with it for a while. I'd be delighted if that happened and we saw everything marked down 20%, because then I would be telling people to jump back in with both feet, but just not today.
Yeah, no, I wouldn't. I certainly wouldn't disagree with that. There's just too much turmoil out there to determine where things are going to go in the short term. In the long term, I'm in agreement with you there as well. It's there's opportunities, but you best be prepared to hold on for 5 or 6 years.
There will be, and look, I want to give a shout out to Hedgeye. Some people follow Hedgeye and Keith McCullough, who's the chief cook and bottle washer there, on Thursday morning. And I'm going to find a link to this. I think it's still available. They did a webinar, which in contrast, starkly so, with all of the carnival hucksterism out there on precious metals, and the end is coming, and we're going to have our bank accounts taken away and be using Biden bucks, or all of the perma bulls on Wall Street, perma bears. It was one of the most useful and level-headed, still sober, still a little scary, but best informed hours I ever spent listening to anybody else's stuff. So for those of you that follow me on social media, when I find that link, I'm going to send it out. Because again, I think that we're going into an environment that's going to be that long-term great stagflation, a slow, dull ache, spreading 2008 over perhaps many years. And nobody is contemplating that, let alone the likelihood that when the Fed does get forced into lowering rates, it is not going to be because inflation has come down that much more. And then we're really going to have problems.
Yeah. Well, let's before we get any more doom and gloom, let's wrap things up there. I will send me that Hedgeye, and I'll make sure that it's included in our description of this particular podcast. And if people want to get a hold of you, what's the best way to follow you?
Twitter is the best on social media. My handle is the @NAT Investor, so just national shortened to NAT, but @NAT Investor. And otherwise, just go to nationalinvestor.com and sign up for our newsletter in the top of the taskbar.
Perfect. And people have been telling me that I should tell everyone to make sure they like, share, and subscribe to this podcast on our YouTube channel. Apparently, I've been social media delinquent and not pointing that out to people at the end of these things. So
you're not the only one. I'm lousy when it comes to that.
We remembered this week. We'll see if we continue to remember over the future. So thanks for joining me. And as I always say, we just don't have a dearth, a lack of things to talk about. So I'm sure in another week or two, we're going to have our pan full again.
No, and we're in yet more uncharted territory. I mean, this is not all going to play out like, the thing that you want to avoid right now, folks, and I'll be the first to tell you, I'm not going to get it all right. No one's going to get it all right. Those that right today are telling you that they think that they're convinced this will all end up in a 1930s style collapse, or they're convinced it's all going to end up in German hyperinflation. The only place they're getting those prognostications is out of their posterior orifice, because this is going to be different. There's a lot of moving parts here, and we got to put them together. And like the fellows on Hedgeye's thing said yesterday, all we can do is look at all of the potential scenarios, look at the facts, look at the trajectory of things in the markets, assign probabilities, and put together a portfolio based on those probabilities, and hope we get more of them right than wrong. And I can tell you that we've been doing that here, but it doesn't mean that we do get them all right. And anybody that tells you they're going to get them all right is, again, don't pay any attention, because it's not even possible right now.
You've definitely got that right. And as I tell people, if you think I'm right all the time, you're delusional. In fact, I'm wrong more often than I'm right. So, but they're discussions that need to be had.
Yeah. Yeah, very much.
Wonderful. Thanks very much, Chris. And you have yourself a great weekend.
All right, Mike, take care.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.